All right. Let's dive into something that might sound a little intimidating at first, the smart money concept. And don't worry, it's not about some like secret society of investors, but more about understanding how those big players, the BlackRocks, the Vanguards of the world, the ones managing trillions, how they actually make their moves in the market.
Yeah, it's like, have you ever noticed how a single news story can make the stock market go haywire?
Oh, absolutely.
Well, that's often the kind of ripple effect we're talking about. And today, we're going to kind of learn how to spot those ripples, maybe even before they become those big waves.
So like we're getting ahead of the curve here.
Exactly. It's a bit like, learning to read the signs of an approaching storm, right?
Okay, I like that.
But in this case, the storm is the market, and the signs are the footprints left behind by these institutional investors.
Okay, so we're talking serious money here, not just you or me dabbling in the market. So what makes these players so different? What makes them the smart money?
It boils down to scale, really, just the sheer size of their trades. Imagine trying to, say, sell 10,000 shares of a stock when there are only like a handful of buyers out there.
Right. You'd be lucky to get any kind of decent price.
Exactly. Now magnify that by like 1,000, 1,000,000. These institutional investors need to move massive amounts of capital. And to do that without, crashing the entire market, they need something called liquidity.
Liquidity. All right. So
Yeah.
it's not just about having the money. It's about having enough buyers and sellers out there to actually make those trades.
Precisely. It's like, think of it this way. If you want to turn a giant cruise ship, you can't just like yank the wheel, right?
Right. You need some space to maneuver.
Exactly. You need a wide enough channel, enough space to maneuver. And for these institutional investors, that space, that channel is liquidity. And they tend to find that in markets like currencies, indices, commodities, those bigger arenas.
So those are their playing fields.
Exactly.
Okay, I'm getting that. But how does all this impact, the rest of us? It's easy to feel like we're just kind of along for the ride when these giants decide to make a move.
Oh, absolutely. And it can definitely feel that way. And that's where the concept of this zero-sum game comes in. So basically, every trade has two sides, right? There's a winner and there's a loser.
Right.
So when an institution makes a huge buy order, someone on the other side of that trade is selling.
Right.
And because of the sheer volume of these trades, it can create these ripples that impact, the entire market, not just those directly involved.
So it's like they're the whales and we're
Will, the little fish.
exactly just trying to navigate these waters.
Exactly. And sometimes those ripples can feel more like, rogue waves.
Oh, tell me about it. So how do we avoid getting swept away then? I've heard this kind of activity described as market manipulation before, almost like the game is rigged,
Yeah, and, it's understandable why someone might feel that way, especially when you see these sudden price swings, these bull and bear traps. It can feel like someone out there knows something you don't.
Yeah. So is it manipulation or just, the nature of the beast?
It's definitely a complex issue, but the reality is these institutional investors are just playing by a different set of rules.
Right.
They're not necessarily out there to manipulate the market. However, they're acutely aware of their influence.
Right, because they're so big.
And they use it, as they have to.
Okay, so I'm starting to see why understanding the smart money concept is so important. It's like we're not just playing checkers here. We're playing chess, and we're playing against a grandmaster.
Exactly.
But, there's got to be some hope, right?
Oh, absolutely. And here's the good news. Even grandmasters leave clues. And with the smart money concept, we're going to learn how to recognize those clues, those footprints they leave behind.
All right, so what kind of footprints are we talking about?
One of the biggest ones, order blocks.
Order blocks, okay. What are those?
So think of an order block as like a price zone on a chart where just a massive amount of buying or selling has occurred, which very often points to, you guessed it, institutional investors.
Ah, okay, so it's like a giant neon sign flashing, big money was here.
Yeah.
But how do we actually spot these order blocks? How do we differentiate them from just the regular market noise?
And that's where it gets even more interesting, because these order blocks, they leave behind these kind of distinctive patterns on a chart, almost like footprints in the sand, footprints in the sand. Picture this on a candlestick chart. You suddenly see this cluster of candles where the price, let's say, drops or spikes really fast, and then there's this kind of gap before it resumes its original trajectory.
So it's not just a single candlestick, but it's this whole zone where things got a little crazy because someone big stepped in.
Exactly. It's like,
Yeah.
imagine like a VIP entrance at a popular club. Right. Everyone else is stuck in the regular line.
Right.
But these guys, they get to just waltz right in, get their trade executed, and then they leave, barely a trace.
Except for that footprint.
Exactly, that order block.
So it's like a little breadcrumb trail, but for like millions of dollars.
Exactly.
Okay, so we got to be on the lookout for these order block zones. What else can tip us off to this smart money activity? What other signs are there?
All right, so another really key concept here is imbalances. They're sometimes called fair value gaps. And basically, imagine like a sudden price jump or drop that leaves this kind of gap on the chart. It's like the market just skipped a beat.
Someone hit the fast forward button.
Yeah, exactly. And you know who often has their finger on that fast forward button?
Let me guess. Those institutional investors.
You got it. It's those big players, right?
Yeah.
Their large orders can just momentarily throw supply and demand totally out of whack, leading to those sudden dramatic price swings.
So these imbalances are like little seismic tremors in the market. And if we know how to read them, maybe we can get a sense of where the tectonic plates, those big institutions, might be shifting next.
Now you're getting it. And what's cool is our source material even points out a very specific 3-candle pattern that can signal an imbalance. So picture this, you got 3 candles in a row. Now, if that middle candle's wick doesn't touch the first candle's body, you've got yourself an imbalance.
Okay.
It's a really small detail, but it's incredibly valuable when you're trying to, really read those smart money moves.
Wow, it's amazing how these, almost seemingly insignificant things are hidden in plain sight on these charts.
Oh, yeah.
But I'm realizing it all keeps coming back to this idea of liquidity.
It always does.
It's like the key to the castle or something.
Because liquidity really is the lifeblood of these institutional investors. It's what allows them to execute those massive trades without, completely moving the market against them.
Right, because they need someone to take the other side of those trades.
Exactly. Think of it as the oil that keeps the engine of their trading running smoothly.
Okay, I like that. So without it, everything just grinds to a halt.
Exactly.
So when we look at a chart, how do we actually see liquidity? What are we looking for visually?
All right, so our source material, it points to a few key things. First, pay really close attention to those maximums and minimums on the chart.
Okay.
Those are kind of like natural gravitational points, right, where the price tends to consolidate.
Okay.
And more importantly, where liquidity tends to pool up.
So they're like those high traffic areas in a city, like where everyone's congregating?
Exactly. And, in a bustling city center, that's where all the action is, right?
Right.
So that's the first thing. Second, keep an eye out for those double tops and double bottoms. So these chart patterns often signal a buildup of buying or selling pressure, which, again, usually means more liquidity is entering those zones.
Ah, okay. So double the tops, double the potential opportunity.
That's one way to look at it. And then finally, don't underestimate the power of trend lines.
Trend lines, okay.
Yeah, those seemingly simple lines, connecting the highs and lows on a chart, those can actually act as magnets for liquidity as well.
It's like they're not just connecting the dots. They're representing these invisible forces that are shaping the market's movements.
Yeah.
And this is where it gets really interesting for me, because it's like, if we can learn to see these forces at play, anticipate them even, it's almost like we're leveling the playing field a little bit, right?
You're catching on quick.
Yeah.
And that brings us to one of the most important aspects of this whole smart money concept, understanding that these institutional investors are playing a longer game than, your average retail trader. They're not looking for those quick profits. They're looking for those sustained trends that they can ride for weeks, months, even years at a time.
Right. That's like a whole different mindset. It's the difference between sprinting and running a marathon.
Right.
Right.
Absolutely.
No wonder we feel a little out of breath trying to keep up sometimes.
Yeah, those are two very different games.
Exactly. So how do we shift our thinking then? How do we train for that marathon, so to speak?
So our source material really stresses the importance of thinking beyond just those single time frames. A lot of retail traders, they get really glued to those 5-minute charts.
Right.
But these institutional investors, they're analyzing the markets on much larger time frames. They're looking at daily, weekly, even monthly charts.
Right. Okay.
They want to see those really big picture trends because those are the ones that can generate those significant returns over the long haul.
So it's like they're looking at the entire forest while we're down here focused on a single tree.
That's a great way to put it.
But if we can, do a little bit of both, see the forest and the trees, that's when we can really start to anticipate those major market moves.
Exactly. You want to have that bigger perspective.
Right. Get a bird's eye view.
And one tool that can really help us understand these larger smart money trends is something called the DOW theory.
The DOW theory. Okay. Refresh my memory on that one. That's all about those long-term market trends, right?
Exactly. Exactly. The DOW theory, it's essentially a way to analyze those market cycles, but by identifying the major trends on those higher time frames, like, your weekly or monthly charts.
Okay.
So imagine a ship navigating the ocean.
Right.
The short-term traders, they're focused on the waves, those like immediate ups and downs.
Right.
But those using the DOW theory, they're charting their course based on the currents, the prevailing winds, essentially, the underlying direction the market is heading in.
Ah, okay. So instead of getting, tossed around by every single wave, we're trying to find those deeper currents that are going to, carry us in the right direction over time.
Precisely. And once you've kind of identified that prevailing trend using the DOW theory, that's when you can start to really align your trades with that bigger picture, even on those shorter time frames.
So it's like catching a wave. If you're, paddling in the opposite direction of the current, it's going to be pretty tough going.
Exactly.
But if you can catch that wave at just the right moment, you can ride it all the way to shore.
Couldn't have said it better myself.
So the DOW theory is all about finding that sweet spot, aligning our trading decisions with those bigger forces at play. Even the smart money has to respect those, right?
Absolutely. They can't control everything. Now, remember those 5 pillars of the smart money concept we talked about earlier?
Yeah.
Well, the DOW theory really ties directly into that very first one, trend.
Right. Trend, order blocks, liquidity, imbalances. What was the last one again? It's on the tip of my tongue.
Change of character.
Change of character. Right. Okay, yeah.
And that one's a little more nuanced, but equally important. It's about recognizing those subtle shifts in the market's behavior that might signal, hey, maybe a change in trend is coming.
So it's almost like the market has a personality.
In a way, it does.
And we have to kind of learn to read its mood.
Yeah.
See when it's starting to shift.
Exactly. Picture like a poker game, right?
Okay.
You've been watching a player, you're starting to notice their tells. And then suddenly, they change their strategy. They start betting more aggressively. Maybe they're bluffing more often. That change in behavior, that should make you pay attention because it might signal a change in their hand. The dynamics of the game are shifting.
It's like they're bluffing.
Yeah.
And the same thing happens in the market.
Exactly.
Wow. So we're looking for those moments when the market kind of acts out of character a little bit so we can adjust accordingly.
You got it. Stay one step ahead. Now, our source material, it highlights one more concept that ties in really nicely with all of this, and that's this idea of break of structure.
Break of structure. Okay.
So imagine the market is moving within these kind of invisible boundaries, like a river flowing between its banks. A break of structure occurs when the price action, that price action, it breaks out of those boundaries really decisively. It often signals, okay, a potential shift in momentum is coming.
So it's like the market's breaking free from its cage or something.
Yeah.
It's a sign that something big might be about to happen.
Exactly. And remember how we were talking about the DOW theory about identifying those trends on those higher time frames?
Yeah.
Well, according to this concept, that break of structure, let's say it's like breaking above a major resistance level on a weekly chart, that could indicate a really powerful surge of buying pressure is coming in, like a clear sign that, hey, maybe the smart money is starting to enter the market here.
Ah, okay. So it's like a signal within a signal.
Exactly.
We see that break of structure. We zoom in on that area, maybe look for some of those order blocks or imbalances, and boom, we've potentially identified a really high probability trading opportunity.
See, you've got it.
It all makes sense now.
Of course, it's never that simple, right? The market always has to throw us a curveball here and there, keep us on our toes. But that's the beauty of this whole smart money concept. It's not about, predicting the future with 100% certainty. No one can do that. But it's about shifting your perspective, starting to think like those institutional investors and really understanding those forces that are driving their decisions.
It's like we're not just watching the game from the sidelines anymore. We're learning the playbook. We're understanding the strategies at play, and we're like stepping onto the field with a newfound sense of, confidence.
That's the spirit. And remember, the more you understand these concepts, the more you start to see those subtle clues, those whispers of the smart money, the more empowered you become as a trader.
That is a fantastic point to end on. This whole deep dive has been really eye-opening for me. It's amazing how much information is kind of hidden in plain sight, if you know where to look.
Exactly. It's all about knowing what to look for.
Well, folks, there you have it. The smart money concept demystified. We hope this deep dive has given you some valuable insights to really up your trading game. Remember, knowledge is power.
Absolutely.
And in the markets, that power, it could translate into profit. So until next time, keep those charts clean and happy trading, everybody.